Gold prices have crashed. Gold prices have crashed. Since 2011, gold has plummeted more than 25%, and the worst may not yet be over. The Profit Strategy newsletter at ETFguide.com warned its subscribers the gold bubble would pop, and it has. Our gold alert given to subscribers in early 2013 resulted in a 500% gain. What happens next in the gold market will shock the entire globe. Join today at ETFguide.com and get a $50 bonus by using promo code SAVE50.
You're listening to the Index Investing Show. This is America's only weekly program focused on the important stock and bond indexes and the financial products that track them.
And now presenting your host,
Ron DeLegge.
All right, welcome to the program. This is the Index Investing Show. Coming up on today's program, bull market in political theater. We've got politicians in Washington, D.C. fighting over everything: budgets, health care, debt ceiling. What will it mean for the market? 877-489-9421. We'll get into that. Also coming up, we'll be doing a portfolio report card for Nolan in Dallas, Texas. He is 32 years old. He's married. He's a pharmacist. We're going to delve into his investment portfolio, and we're going to look at his allocation. We're going to look at his holdings. We're going to look at the value of those holdings. And then what I'm going to do is dissect this portfolio. We're going to cut it open. We're going to dissect it to its nudity and look at it in 5 key categories. We're going to look at it in terms of risk. We're going to look at it in terms of diversification, tax efficiency, performance, and cost. And then at the end of that exercise, we're going to give them a final grade of A, B, C, D, or F. So remember, A or B is passing, C, D, or F is obviously not passing, not adequate. So stay tuned for that. We'll be doing a portfolio report card for Nolan. And if you'd like to touch base with me to talk about a particular stock, mutual fund, ETF, investment theme, you want to talk about the political theater in Washington, D.C., 877-489-9421. You can also tweet the show at Index Show is my Twitter handle. My email address, ron@indexshow.com. So we've got a lot of things that the market is focused on, beginning with the federal debt limit, which is $16.69 trillion. That was set on May 18th, 2013. And since then, the Treasury's been using what they call extraordinary measures to avoid defaulting on the nation's debts. And they have just said that October 17th is the official date where, if Congress doesn't act and come up with some type of extension, that the U.S. Treasury will officially be out of money. And at that point, who knows what they'll do. By mid-October, again, that's October 17th, the exact date, these extraordinary measures will be completely exhausted. So here's the bottom line, and I like to cut to the chase, and I like to also help you understand that this is a giant dog and pony show, okay? Because the bottom line statistics and history will repeat themselves as they always have. Since 1960, Congress has acted 79 separate times to permanently raise, temporarily extend, or revise the definition of the debt limit. So if you don't think there's going to be an 80th time, call the show, because I want to sell you a bright red bridge. I want to see how much I can extract from you, because you're a gullible son of a gun if you don't think for a second that Congress is not going to do the same thing that it's always done since 1960. I mean, come on. This is their pattern. This is what we call in financial markets a trend. Now, it's a political trend. But do you see what's happening here? They're just focused on short-term fixes. That's all. Deadlines that they always seem to have. And the point here is that the train, you have to have a bigger picture. The train is heading with such velocity in a certain direction and that can't be changed. And that trend is one of spending that cannot be stopped. And right now, the bond market really not showing any signs of fear. I mean, if you take a look at the 10-year U.S. Treasury bond, we danced with 3% a couple weeks ago. We're now at 2.62%, so we're down about a little more than 0.25% over the past several weeks. So there's no signal of stress. There's no signal of fear when we see bond yields heading down as they have been. So that's the signal. Now, I've told you before, and I still feel very strongly about it, that we will dance with 3% again, and we will go above 3%. And the trend of higher interest rates is still firmly rooted. That has not changed. If we look at the pattern or the trend of interest rates over the past year and also year to date since the beginning of the year, we're looking at a more than 40% rise in the yield of 10-year U.S. Treasuries. Right now, we're at 2.61%. There you have it. Don't fight the trend. And if you do, well, you better have some battle armor. 877-489-9421. You're listening to the Index Investing Show. Great to have you with us. My October ETF Profit Strategy newsletter has just been released. It's packed with a whole bunch of money-making strategies and ideas. My mega investment theme report, which I'll share with you again, my top 3 investment mega themes of 2013. And we grouped them all together just so that we can organize our ideas and understand what's happening in the financial markets and what are the biggest things that are moving the market. So we'll break that down for you. Also, we'll be doing a portfolio report card for Nolan. He's in Dallas, Texas. He's 32. He's married. He's a pharmacist. He asked me to take a look at his investment portfolio. He's got a Roth IRA, a traditional IRA, and then a 401k plan. And he wants me to look at that portfolio, all of those, on an aggregate basis, and grade it. He wants to know if he's doing good, if he's doing bad, or somewhere in between. So we'll do that together on today's broadcast. 877-489-9421. That's the number if you want to join us. We're here. I don't know if you saw this story, and I wrote this several weeks ago at etfguide.com. You know, this debate about the debt ceiling and all this stuff about how, you know, it has to be once again raised. Well, the U.S. Treasury, FYI, if you didn't get the memo, has already exceeded the debt limit by $39 billion. They did this with an accounting trick. And the accounting trick is this. They come out with this daily report that shows what the total public debt outstanding is and then what the statutory debt limit is. Okay? And they've been $39 billion over the statutory debt limit since May. So the point here is this $39 billion that's above or in excess of the statutory debt ceiling or debt limit is really, it's heinous, is what it is. They've got this $39 billion categorized, as they say, quote, and this is their words, not subject to the debt limit. Can you believe this? This is the U.S. Treasury taking $39 billion over the statutory debt limit and saying that it's not subject to the debt limit. You know what that's called, ladies and gentlemen? That's called creative accounting. And I would like to state that anybody in corporate America that would practice this kind of accounting would go straight to jail. And yet we've got the U.S. Treasury with this creative accounting trick going $39 billion over the legal debt limit. So they've got Hope Bonds, Federal Financing Bank, unamortized discount, all this nonsense categorized as $39 billion not subject to the debt limit. What do you think about that? What do you think about this creative accounting trick? Any accountants listening to the program? Do you just take your liabilities and just all of a sudden say that they're not subject to any debt limit in your own personal finances or for your clients? Let me know how that works out. 877-489-9421. 9421 is the number. You're listening to the Index Investing Show at Index Shows, my Twitter handle. Coming up next, portfolio report card for Nolan in Dallas, Texas. My mega investment theme report, be here or be nowhere.
The Index Investing Show with DeLegge.
All right. Welcome back from the break. 877-711-56. I'm sorry. 877-489-9421. Again, 877-489-9421. At Index Show is my Twitter handle. Ron at indexshow.com is my email address. Got a tweet I want to read from a listener named Eric Weber. At Eric Weber 4 is his Twitter handle. And he was listening to the podcast where I broke down the collapse in gold prices and what that meant. And he said, Ron, I love your Old Testament prophet or prophecy of end of times prophecy reference. Basically, gold is in serious trouble. And that particular prophecy is recorded in Ezekiel 7:19. Now, this is not a religious program. And we typically do not make secular applications to biblical references or biblical texts. But this one applies, ladies and gentlemen. And let me tell you, even if you're a non-believer, even if you're an atheist, you can appreciate Ezekiel chapter 7, verse 19. Because basically what it's talking about is market capitulation. And if you don't have a Bible, well, you can just go to Google and search Ezekiel chapter 7, verse 19, which in part says, into the streets they will throw their silver, and their very gold will become a thing of abhorrence. So when we see that moment, and we haven't yet seen it just yet in the gold market, that will be your buy signal. That will be the point of market capitulation, where people want absolutely nothing to do with precious metals. And we're not at that point just yet. We still have Indian consumers and Chinese consumers going bonkers for gold and silver. They're going nuts. They can't get enough. And when we see a reversal of that trend, and we see the point globally, utter disdain for gold and silver, that will be your buy signal. Be patient. Be patient. Don't listen to any of these gold experts, these financial perverts, people like Peter Schiff and James Turk that tell you, oh, gold's going to $5,000 an ounce. Gold's going to $10,000 an ounce. Don't believe them. Don't listen to them. They're dangerous to your net worth, and they're a bunch of financial perverts is what they really are. They've been perverting the truth. They think they want to make you think that gold prices are heading up, when in fact they are not. Gold has been in a bear market for 2 years, and the Spider Gold shares, ticker symbol GLD, which tracks the price of gold bullion, since the beginning of the year has fallen around 20.5%. So almost 21% down, and silver, of course, performing even worse. Gold miners, wow, there's been another area of the market, one of the few that's just been horrific. Gold miners as a group down more than 35%. Ticker symbol GDX tracks gold mining stocks. And we have made several profitable trades on this theme of lower gold prices. Our latest one, which is time-stamped, it's available at etfguide.com. When you become a subscriber of the Profit Strategy newsletter, which I publish every month, you'll also get a technical forecast and weekly picks. And our weekly pick from just 2 weeks ago had a trade on ticker symbol DUST, which aims for triple daily opposite performance to gold miners. And that was a 2-day trade that resulted in a 16.5% gain. And that was the day, by the way, if you forgot, on September 18th, when gold and gold miners rallied in a big way because the Fed said, well, they're going to continue with quantitative easing, all of these gold bugs and gold perma bulls came out of the woodwork saying, oh, gold and gold miners are going to the moon. Well, that was a short-lived one-day rally, and one day never makes a trend. And we took the opposite view, and we realized very quickly that this was a short-term phenomenon. We jumped into DUST at $24.50 a share, and we rode that for a 2-day 16.5% gain. We also had a tandem trade on put options, which are designed to increase in value when the underlying ETF declines. We had put options on GDX that resulted in a 2-day 68% gain. So these are the kind of moves that you can make when you're on the right side of the market and when you recognize market sentiment is extreme. And it still is extremely, extremely bullish in the gold market. 877-489-9421. That is the number. We're here if you'd like to join us. Taking a look at some of the performance of key market indexes and benchmarks since the beginning of the year. Despite all this political theater and the nonsense that we continue to see out of Washington, D.C., the stock market has not yet really reflected any sort of fear. SPY, which tracks the S&P 500, ahead by just over 20% since the beginning of the year. And you've got all 9 industry sectors within the S&P 500 in positive territory. The ones that are leading the way are healthcare stocks. XLV is the ticker symbol of the ETF that follows S&P healthcare stocks. Again, XLV ahead by almost 29%. So you see there healthcare as a group easily outperforming the broader S&P 500. XLF, which tracks financial stocks and banking stocks, ahead by almost 24%. That sector also outperforming the S&P 500. And then one more, industrial stocks, ticker symbol XLI, ahead by around 25%. And again, that sector outperforming the S&P 500. You've got the total U.S. bond market, ticker symbol BND, down 2%. And what's been going on there? Well, very simple. When interest rates rise, as they have been, bond values or bond prices decline. So that's the current trend that we're in. And although it has temporarily halted or reversed itself, not in a very big way, but temporarily, we nevertheless see this trend still firmly rooted. Higher rates, lower bond prices. Ticker symbol VEA follows international stocks, which as a group have done pretty good, ahead by almost 16%. Emerging market stocks from places like China and Brazil and India have not been good performers. As a group, VWO, which tracks emerging market stocks, down almost 7%. So there you have it. Take a look at your own investment portfolio and compare the performance of your mutual funds and of your own investment portfolio as a whole versus some of these major benchmarks. 877-489-9421. That is the number. We're here. You're listening to the Index Investing Show. If you'd like to join us to talk about a particular stock, mutual fund, ETF, I'm game. We're going to get into a portfolio report card for Nolan. He's in Dallas, Texas. He's 32. He's married. He's a pharmacist. We're going to look at his investment portfolio. Before we do that, on October 7th, Direction Shares is sponsored an ETF trading challenge. And we've got a link to it on our Twitter account at Index Show. And basically, you can test your strategies, whatever they are, without risking any of your capital. And you can also compete for weekly and grand prizes. So go to our Twitter handle at Index Show. I've got a link to that. It is free to join and participate. There's also going to be a kickoff webinar on October 7th. And that trading challenge runs through December 13th. But it begins on October 7th. So at Index Show is our Twitter handle. I'll also provide a link on our Facebook account. Actually, I already have the link there, so you can check that out. 877-489-9421. You're listening to the Index Investing Show. I'm Ron DeLegge. Please join us. My ETF Profit Strategy newsletter for October is out. Pick up a copy. Go to etfguide.com. When I come back, I'm going to share with you my top 3 mega investment themes. I'll be right back.
The Index Investing Show with DeLegge.
Meet Joe Investor. He's nice and he means well, but Joe Investor always misses the really big investment opportunities. For example, Joe Investor missed last year's 16% gain in small company stocks. And the year before that, he missed the 33% gain in long-term U.S. Treasury ETFs. And what about this year? Well, like all the times before, Joe Investor once again is all about lost opportunities and missed chances. Are you always missing out, just like Joe Investor? The Profit Strategy newsletter at etfguide.com will help you to stay on top of major investment trends so you never miss another big opportunity. Join today and get a $50 bonus by using promo code JOE50. Our monthly newsletter, our weekly picks, and our technical forecast will keep you ahead of the pack. Go to etfguide.com to get started. And one more thing, promise yourself to never ever miss another big investment opportunity.
All right, welcome back from the break. 877-489-9421. We're doing a portfolio report card for Nolan in Dallas, Texas. 32, married, pharmacist. We'll get into that. Before we do, let's go to San Rafael, California. We've got Scott with us. Welcome to the Index Investing Show.
Hi, Ron. I have a question about the ETF. It's PST, Peter, Sam, Tom. What do you think about that one?
Yeah, that's the ProShares Ultra Short 7 to 10 year Treasury ETF. Do you own this one?
Yes, I do.
Okay. Well, you've done pretty good if you've held it since the beginning of the year. It's up about 6.2%. Over the past month, it's lost around 2.5%. And what this ETF is designed to do is use double or 200% daily leverage opposite to 7 to 10 year U.S. Treasuries. So as prices for 7 to 10 year U.S. Treasuries fall, PST is designed to increase in value. So I think it's still a good trade. I think we're going to see a pickup again in interest rates, and really the ones that are most sensitive, Scott, to any increases in interest rates is not the 7 to 10 years. The 7 to 10 years are definitely impacted, but less so than long-term treasuries. We're talking about treasuries with expirations or maturities, rather, of 20 years or longer. So look at ticker symbol TBT, Thomas, Boy Thomas. That uses 200% daily leverage opposite to long-term U.S. Treasuries. And then TMV, Thomas, Mary, Victor, uses 300%. So I think when we see this temporary halt in increasing rates end, which I think it will, we're going to see these types of ETFs really shine.
Okay. I mean, what's your long-term thing for interest rates? They have to go up long-term, don't they?
Well, I don't. Long-term, come on. In long-term, we're all dead, right? So I try not to make long-term predictions because, well, no one's good at that. So why should I throw my hat into the ring? I just follow on a short-term basis what I see happening, and right now I can tell you that the short-term to intermediate trend right now is rising rates. So these types of ETFs, PST, TBT, TMV, are designed to capitalize on that trend. And if we see this, I've told you before, we're going to dance with 3%. I strongly feel that is what's going to happen. Especially, too, think about this, Scott. We've got the Fed, which will have to scale back quantitative easing. Now, I know they didn't this time around, but if they do in December or shortly thereafter, they're going to have to take this market off of steroids. Less bond purchases, think about that. Less bond purchases, what is that going to mean for Treasury bond prices? Well, it's not going to be good. It's not going to be good. Now, will this market collapse completely because the Fed slows down or scales back? Who knows? I probably not, but we don't know. But it will definitely be impacted. We appreciate the call, Scott.
Thank you.
877-489-9421. Let's do our portfolio report card for Nolan. We've been talking about it long enough, and it's time for us to get into it. So I asked Nolan, as part of the what you might say pre-diagnosis phase, what was the best investment he ever made? He said the best was he bought many individual stocks in 2009. Well, that was a good time to buy stocks, probably right at the bottom, right? When the market was at its worst. He bought GE, he bought several other individual stocks, ZION, WGL, MCO, COP. So he made some money from those gambles. Now, the worst investment he ever made was he bought Bank of America shares at $15, and he lost about $3,000 to $4,000 also in penny stocks. So those were some of his mistakes. His philosophy when it comes to investing is he considers himself a long-term investor. He believes in low-cost index funds, amen, and he says, I would also like to have an investment account that would generate some income. So we're looking at a Roth IRA, a traditional IRA, a 401k plan, and we're going to dissect this. He describes himself as an aggressive investor, and he also self-directed, or he manages it himself. His primary goal is growth. His secondary goal is to generate income. So let's begin by taking a look at some of his holdings. Let's begin with diversification, which is really the first category in determining whether a portfolio is adequately or constructed correctly, I should say. So he's got the Vanguard. He's got all Vanguard and Fidelity funds. He's got a Vanguard Small Cap Index Fund, ticker symbol VSMAX, Vanguard Mid Cap Index Fund, VIMAX, and then he's got those two in his traditional 401k plan and his traditional IRA. He's also got the Fidelity Spartan International and Extended Market Index Funds, FSEMX and FSIIX are the ticker symbols. And in terms of diversification, I think he does okay. He can certainly do a lot better. He's also got a S&P 500 fund, which is institutional share class. That's VINIX. In terms of diversification, he's missing a couple of key asset classes. Number one, he's got no exposure to bonds. He's got no exposure to real estate or REITs. And then he's also got no exposure to any commodities in that particular area. So these are three major asset classes that he's missing market exposure to. And I don't care how aggressive you are or how unaggressive you are as an individual investor, you got to have exposure to all the major asset classes, period, if you're going to pass when it comes to diversification. So Nolan's got to do some work in that department. Now, in terms of cost, the benchmark of a well-built investment portfolio is one that minimizes investment cost to the owner as much as possible. And of course, low-cost index funds and index ETFs do exactly that. They minimize your investment cost to the greatest degree possible without stabbing yourself all over the place with many wounds. So in Nolan's case, this is what he owns. This is the foundation of his portfolio. He's got Vanguard and Fidelity index funds. That's good. And the average expense ratios, all of these funds, well under 0.25%. In some cases, some of them less than 10 basis points or 0.10%. That's fantastic. That's what you want to be doing. You want to be deliberately minimizing your investment costs as much as possible. And he has done this, and I congratulate him for that. All of our listeners should be taking that step. So now we got to look at a couple of other areas. We're going to look at risk. We're also going to look at tax efficiency. We're going to look at performance, and then we're going to give them a final grade. So stay tuned for that. 877-489-9421 is the number. @Index shows my Twitter handle. If you ever miss our regular a weekly broadcast. You can pick up our podcast. We publish the archive of all of our shows. It's available on our iTunes account. Just search under the Index Investing Show. Also at YouTube, we now publish our podcasts, so you can search for the Index Investing Show there also. I also want to cover my mega investment themes. I got my top 3. I'll begin with number 3, and then I'll give you a rundown of number 2 and number 1 in the next segment. Number 3 are falling commodity prices, which if you look at them on a year-to-date basis, all the ETFs tracking broad commodity indexes are down. And we've got a really serious collapse in the price of industrial and precious metals, which have been leading the way down. But the point here is this is the deflationary warning sign for other major asset classes. We're already seeing it in commodities. So watch out. Watch out some of these other asset classes like stocks, like real estate. Take your cue from commodities. Coming up next, we're going to finish Nolan's portfolio report card. We'll also give you a recap on my mega investment theme report, number 1 and number 2, mega themes. I'll be right back.
The Index Investing Show with DeLegge.
All right, 877-489-9421. You're listening to the Index Investing Show. At Index Show is my Twitter handle. And I'll give you my final 2 mega investment themes as highlighted in our just published ETF Profit Strategy newsletter, which is now available at etfguide.com. We already gave you number 3, which is the fall in commodity prices that's serving as a deflationary warning sign for other asset classes. My number 2 theme are rising interest rates. And we've got a 40% plus year-to-date surge in the yield on 10-year U.S. Treasuries. It is a serious threat to rate-sensitive industry sectors like home builders, like REITs, like utilities. It's also a threat to the broader economy. Higher interest rates make the cost of servicing debt more expensive. It puts pressure on borrowers. It also hurts the mortgage market. We've seen a huge drop-off in mortgage refinancings. I think around 70% collapse since May in mortgage refinancing. And what about the U.S. government? They've got $17 trillion in debt. Higher rates is not going to make it easier for the government to pay down that debt or to make a significant dent in it. And then, of course, my number 1 theme is politics, bull market and political theater. And really, you take a look at not just here in the U.S., but worldwide, Europe, Japan, politics and invasive monetary policies are contributing to market bubbles. And we've got here in the U.S. a continuation of the battle of the debt ceiling. We've also got the Federal Reserve, which this time took a pass on scaling back quantitative easing, but they're continuing to do that. And it's certainly impacting the market. It's creating market bubbles, which will eventually lead to instability. So that's my number 1 mega investment theme. And I've got a list of 10. I just gave you the top 3. There are 10 in my mega investment theme report. Again, that's contained in the ETF Profit Strategy newsletter. And go to etfguide.com to subscribe. So let's finish off our portfolio report card for Nolan. We already gave you kind of a quick recap of what some of his holdings are. I forgot to mention this, that the total aggregate value of all these holdings is $137,000. So that's what he's got invested in his Roth IRA, traditional IRA, and his 401k plan. And this is a self-directed investment account, all of them. And he's got mainly Vanguard index funds and Fidelity index funds. So we already graded him on tax efficiency, cost and diversification. He did good in the cost department. He's minimizing his investment costs as much as possible by owning those low-cost index funds. That's outstanding. He does need to work on diversification. He lacks exposure to bonds. He lacks exposure to real estate, commodities. Those are the three major asset classes that I identified that he's missing exposure to. Now, what about risk, tax efficiency, and performance? Well, all of these are tax-deferred retirement accounts, so we can't really give them an official grade on tax efficiency. There is no problem in that area. Now, if he held these types of investments, these index funds, in a taxable account, I can tell you he would not have any problem passing with flying colors my tax efficiency score because, well, index funds and index ETFs are extremely tax efficient investments. They don't soak or sock their owners with any hidden or unexpected tax liabilities. Now, occasionally, some of those leveraged and inverse specialty type of ETFs will have tax distributions, but we're talking about just the traditional index fund that invest in stocks and bonds. We're not talking about the specialized funds. Extremely tax efficient. So he's okay in tax efficiency. In terms of risk, what we want to see are investment portfolios that perfectly match a person's risk tolerance. And in this case, he describes himself as an aggressive investor. His primary goal is to grow money. And I think Nolan has a portfolio. It's not, in my opinion, optimally designed, but it is aggressive. I mean, he doesn't have any exposure to bonds whatsoever. He's pretty much 100% allocated to stocks. That's about as aggressive as you can get. So in terms of risk, I think he matches perfectly his profile, but at the same time, we need to be smart about risk. We can't just take risk because, well, there's more reward, because with risk, it can work two ways. This type of 100% all-stock portfolio in a market that falls will be badly damaged. Now, we haven't had a falling market really since 2009. We've had intermittent periods or short periods, abbreviated periods of market declines, but nothing lasting. But now is the time to shore up your portfolio, Nolan, and to balance out the risk. And you can do that by having some exposure to some of these other asset classes, like bonds, like REITs, and like commodities. And also, too, let's not forget cash is an important asset class that gets often overlooked. And I think it's always good to have a little bit of cash in a portfolio. And I don't care if you're aggressive or not aggressive. It's always good to have some cash. It will cushion you when the market declines. It will also afford you the opportunity to buy at lower prices should market conditions go on sale. And when everyone else is selling, well, you don't have to sell. If you got a little bit of cash, you can actually do the opposite, right? You can buy. So let's take a look at the final category or area, performance. And really, this is the bottom line. Your performance will suffer if you stink when it comes to cost, if you stink when it comes to diversification, if you stink when it comes to tax efficiency, and if you stink when it comes to risk. Now, in terms of market performance, we got this $137,000 portfolio that Nolan has in his Roth IRA, traditional IRA, and 401k plan that has grown by $21,927 over the past year to $159,498. That return has been a 16% gain. How has that compared to the broader market indexes? Well, total U.S. stock market over that same time frame has gained 21.5%. So Nolan has slightly lagged the broader U.S. stock market, and he did good. I mean, he had a 16% gain. That's not bad, but he did not beat or outperform the broader market with this particular mix of investments. So final grade for Nolan, he gets a C. He gets a C, and I think he is doing okay. I mean, he's reducing his investment costs. That's outstanding. He recognizes the importance of minimizing investment costs. But he's got to do better in some of these other areas. I think he really has to rethink risk and add some other asset classes to the mix so that he can improve his performance. And I think if he does that, he's going to have much better results heading into the future. So, okay job, Nolan. We appreciate you taking our portfolio report card. And if you'd like to get your own portfolio report card, you want me to dissect your investments and tell you how you're doing, just get in touch with me, Ron at Index Show. You can get in touch with me there. And you can also tweet me at Index Show is my Twitter handle. So I want to give you a quick final recap here of our monthly income trade. We do this once a month, and every single month we sell covered calls on an all ETF portfolio. We've got 3 ETFs tracking major asset classes, U.S. stocks, commodities, and then REITs or real estate. So for our October trade, we just generated $754. So that's based on a all ETF portfolio with a $100,000 hypothetical value. And over the past year, from September of 2012 to September 2013, we've averaged a 10.9% yield, which is the amount of income that we've been able to generate. So if you want to follow along with our next monthly income trade, which will be coming up for November, just go to etfguide.com and click on Ready to Go Portfolios. That does it for another episode of the Index Investing Show. Join us again next week. And until we meet again, may the market indexes be with you.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producers.
Downsized, outsourced, pink slipped? Afraid of losing your home? Forbes magazine